Hey guys, welcome back to the channel. Today we're talking about the best UK stocks that you can buy for your portfolio for 2022. All of these are dividend paying stocks. They all feature in my dividend portfolio. I've been buying these stocks consistently through 2021 and will continue to do so through 2022 as well. I believe that there is a significant dividend growth opportunity within these companies and share price appreciation as well. If that sounds like something you're interested in today, guys, please smash that like button, consider subscribing to the channel, and I'll catch you in there. Hey guys, welcome into the video. So, as mentioned, I'm going to be presenting the 5 best UK stocks that you can buy for your portfolio for 2022. I'm going to start this round off with GSK, GlaxoSmithKline. Now this company over the last year took a bit of a hammering, to be fair. Back in February 2021, it was down at the £12 mark, and I bought into my portfolio right there. I added at that point, and that this was caused by the company potentially, well, is going to break itself into two. So there's going to be a biopharmaceutical side of things, and then there's going to be a commercial side of things as well, and that caused a little bit of panic through investors. This, I believe, is a significant opportunity for investors in GSK to get a return on investments in both ways. GSK Biopharma should be able to grow its share price quite nicely, as you'll see in a minute, and then the commercial side of things will be a consistently good company offering really good drugs, really good treatments that will also pay a dividend as well. The biopharma side of things is also going to pay a dividend too. So the market cap is £80 billion. It has a PA ratio of 18, which isn't too bad at all. It tends to beat its earnings, albeit it's in US dollars at the moment, but it has stagnated as late in terms of its revenue growth, which is what has spouted this breakup of the company into and combining with Pfizer. However, its actual profit is actually doing quite good as well in terms of its earnings. It has a buy rating, an average price target of 16.49. Current share price is 16.06, a low of 13.50. It was well below that at one stage, which is exactly why I bought, and a high of £21.75. Now we're going to just pop through and move on now to exactly what is going to happen in the new year to GSK. So it's going to break into two companies. You've got new GSK here and the new consumer healthcare company there, and this is what the company believes it has achieved so far. So the new consumer healthcare company is going to generate over 10 billion in net sales, hopefully +4 net sales growth from 2020, and hopefully it's going to be able to build on that into 2022 and 2023 and beyond going forward, with 23k employees. And there you can see 9 power brands there at the bottom: Voltron, Sensodyne, Centrum, all treatments and wellness goods being provided by GSK amongst others. The separation is on track for mid-2022, and the separation is going to be 68% GSK ownership, with this being potentially monetised to provide extra balance sheet for the biopharma side of things of the new GSK side of things. So we're going to end up with two separate companies, both still listed on the stock exchange, but the old GSK is going to hold on to most of the shares, but are going to sell up to 20% of them to swell the balance sheet basically, and have some extra, build a war chest for better treatments. So this is what new GSK is proposing to do. I'm not going to read it all to you, but this again provides an excellent opportunity for investors to get in, and this share price that it has, even at now it has recovered to £16, could still be fairly cheap for the coming years. Right, moving on to the next company. The next company is Boohoo, of course. Now this company has been absolutely hammered over the last year or so, down to £1.07, £1.06 at one stage from its highs of £3.50 or so. Market cap of 1.5 billion, P ratio of 26. This company is still in a high growth phase. It is still sitting on an awful lot of money. It is still dominating its market share and is building its growth out quite nicely. Just hopping on down to the charts just shows you just how rapidly this company is growing, and its profit is starting to grow as well. It's rated quite strongly as a buy. Average share price consensus of £2.08p, which would give you a pretty significant return on where the current share price is. But there is a low of 95p a share, which is, it's actually quite near, and a high of £3.50. If we quickly have a look into the way they're doing things at the moment, they've saw 73% growth in revenue over 2 years and 46% growth in customer numbers, doubled its market share in the UK and the US, larger addressable market than ever before, and this market is still growing. They have highlighted a few headwinds ahead, but I believe that this company will still continue to grow and grow its revenue and grow its profit, just not as much as it perhaps would have done had the pandemic died off a little bit, or had the headwinds not been there in the first place, of course. And this again just shows the revenue that this company has been going through. Very strong revenue of 1.7 billion for 2021, and you can see that the charts read off quite nicely indeed. Moving on to our next company then, that is Royal Dutch Shell. This is a favourite company of mine. RDSB stock is absolutely fantastic. It got absolutely destroyed in the pandemic. Everybody was selling off because they thought that the future was electric and this company was getting hammered. Nobody was using oil, which was absolutely right at the time. Nobody was using oil, but oil still has a very large part to play in the world going forward, and this company does have one eye on the future as well, which is great. It is using oil revenue to fund renewable and more sustainable energy, and this company is an energy company as a whole. A market cap of 128 billion, a PE ratio of 36, come down a little bit from its high of $17.95 in the last year or so, but during the pandemic I bought into this massively, and I'm now sitting 20-30% up on it. So as you can see, its revenue did take a hammering in 19 and 20, but it is bouncing back nicely. It is again initiated as a buy. It has a high price target of $41, a low target of 16, and a average of £22. I don't think that has updated properly at all there, because it's a little bit weird looking at that point. So we'll just gloss over that, because that obviously isn't right on the Yahoo Finance side of things. Anyway, Royal Dutch Shell trades, according to Barron's, at a significant discount in comparison to its US peers. This company is listed on the US stock exchange as well, so there is a good opportunity for US investors to also get involved in this company. I believe that this company it always takes care of its investors. It's okay, it took a dividend cut in 2020 due to the pandemic, but how could it not get around that? It is on top of things. It is reducing its debt. It is now recovering absolutely nicely as global travel and people are starting to move around a lot. It is actually rated as one of Barron's top stock picks for 2022, seeing EPS price grow by 2 basically, and some really good metrics coming through there, a nice dividend yield as well. If we have a look at Shell's future strategy, we can see that it wants to decarbonise. This is absolutely huge. It wants to build out far more service stations and install 500,000 EV charge points, up from the 60,000 it has in 2020. So that proves that it's just, the strategy is there for it to move to a more sustainable footing in the environment side of things, and that is exactly what they're pushing for, and they are a very valuable brand in their industry as well. Just looking at the slide below there, I can't go through this because it's 78 pages long. I've got other stocks to cover, guys, but do have a look at Shell. They will take care of you, I'm certain of that. And just a quick look at how they've been doing there in the last quarter results. They have a positive cash flow of 12 billion. They reduced their debt by 8 billion. The debt is now the lowest level since 2016 and falling, and they are still returning money to shareholders as well. They're managing to burn both ends of the candle, basically reduce debt, still be highly profitable again, and pay off that debt load as well, which is absolutely great, albeit being slightly high at 57 billion, but it is coming down nicely, and that is exactly what we want to see as investors and gives us value. The next company we're going to talk about is Bunzl. Now this is a strong play. This is a robust company. It's actually sitting quite high at the moment at £28 a share, up from a low in October of £23, which would have been an ideal buy point. It has a market cap of 9 billion, a PE ratio of 21, and a growing revenue, not massively, but definitely single digit solid growth that it can just continues to do year on year on year. It is rated just above a hold at the moment, to be fair. It is sitting just above the average consensus for analysts, even though it can go up to a high of potentially 33 and then down to a low of 21. This company is reasonably valued at the moment, but there is a reason for that, because it has proved so robust in the pandemic. However, when the pandemic subsides and people can go out eating again and go out drinking, this company again will be there to provide that sort of support. And if you have a quick look on the Motley Fool here, I just highlighted this little article here. It does prove to be a robust company. It is growing, it just grows every year, almost no matter what. And again, this was highlighted in this little article here as a pick for 2022 on the FTSE 100 by Roston Wild on the 18th of December. And if you have a look on the investing side of things, it does an investment case, and here you can see a lovely compound annual growth rate from 04 through to 20. Same for adjusted profit in revenue, same with dividend per share growing up nicely, and the adjusted EPS flying up nicely as well. And this is a solid track record. Obviously past is never an indication of the future, but it gives you an indication of just how well the management have been doing in the past. And recently they've acquired 2 new companies to add to the feathers in the cap. You got Workwear Express and then Hydropack as well, adding to their significant revenue stream and hopefully going to help them businesses grow as well. Now, the last company we're going to talk about today is another stalwart of any dividend portfolio, in my opinion, and that is Legal & General. Has been growing quite nicely over 2021, so it's going to push forward in 2022 as well, and I'll show you exactly what it's got coming. There has been some really good buy opportunities over the last 5 years. If you pick your dollar cost average or pick your time just nicely, you can get a significant return out of this one. Market cap of 17 billion, a PE ratio of just a 7, which is pretty good. It seems a little bit undervalued in my opinion. A dividend yield of 6% and a safe dividend at that. We have a look at their pre-performance. They're now doing well above pre-COVID and 2019 levels. Profits double-digit growth, which is exactly what we want to see. And then they're using this money to invest going forward to contribute to their growth from 2022 2024, and there's a good strategy in place for that. This is their strategy for growth, a number of growth opportunities in the global PRT side of things, pensions, high growth, low penetration markets, entry into China, not necessarily an insurance side of things, but still entry there, and digitising the US term life and the real estate assets as well. Lots of opportunities to potentially be had there. You can see the revenue growing up quite nicely, and this is where we have the building back better and levelling up here for the UK. This company is heavily involved and heavily invested in helping out in the UK as well. As you can see, they've invested a significant amount of money and been buying up at a cheap time, because the property markets haven't been so robust, with especially in the retail sector, with a lot of shops shutting. These guys are buying that up on the cheap and then will hopefully invest in it and sell it off at a higher price. So that again is just a small segment of what Legal & General do, but it just proves that there is an investment case right there. So those are the best 5 dividend stocks for your portfolios today, guys. I've absolutely enjoyed digging them out. I'm an investor in every single one of these companies for the reasons that I've just mentioned above, and so much more. If you do due diligence and dig into all of them, there are opportunities to be had. I'm not saying they're going to be multi-bagging companies, but what they are going to do is consistently pay you, consistently grow the amount that they're paying you, and there should be a decent amount of share price appreciation in them as well. So hopefully you've enjoyed the video today, guys. If you could see your way to liking and subscribing to the channel, that would be absolutely awesome. See you in another episode.